Most people are playing the wrong game. They're sprinting toward a finish line that keeps moving, saving 15% of their paycheck, maxing out a 401k, praying the market cooperates, and then maybe retiring at 67 with enough left to enjoy a few good years before their knees give out. But there's a quieter group of people doing something different, something almost embarrassingly simple. And a surprising number of them are retiring in their 40s. Not because they struck gold, not because their parents were wealthy, and definitely not because they hustle 80 hours a week. They did it with one house, not a portfolio, not a real estate empire, one intentional property, used in a way most homeowners never even think about. Here's what nobody tells you about wealth building. Complicated doesn't mean powerful. In fact, the most reliable paths to financial freedom are often so boring that people scroll right past them looking for something more exciting. Meanwhile, the boring strategy keeps compounding in the background, quietly, patiently, unstoppably. So let me show you exactly how one house can become your early retirement engine. First, let's kill a myth. The moment most people hear real estate investing, they picture one of two things. Either a guy with 30 rental properties and a property management nightmare, or the HGTV couple flipping houses every 6 weeks. Both images are exhausting, and neither one is what we're talking about. This strategy is different. It's not about volume. It's not about speed. It's about understanding that a single, well-chosen property does something extraordinary over time when you stop treating it like a place to sleep and start treating it like a working asset. Here's the core idea. A home builds equity. Most people know that. What they don't do is use that equity. They let it sit there, hundreds of thousands of dollars locked inside the walls of their house, generating exactly nothing. They call it security. I call it sleeping money. And sleeping money doesn't retire you. The strategy flips that entirely. You build equity deliberately, then you deploy it, turning dormant value into active income streams that eventually outpace your monthly expenses. When your passive income clears your cost of living, you're free. That's it. That's financial independence. Not a magic number in a brokerage account. Just enough reliable income that your paycheck becomes optional. So how does this actually work? Let's break it down. Step 1 is buying right. And this part matters more than anything else. You're not shopping for a dream home. You're acquiring an asset. That means you're looking for a property with 3 specific qualities. First, strong and durable rental demand. Think middle-class neighborhoods where professionals want to live. People with stable incomes who aren't quite ready to buy yet. Not luxury, not distressed. The reliable middle. Second, value-add potential. Not a 6-month gut renovation, but a property where smart, targeted upgrades, modernized fixtures, better curb appeal, and improved floor plan can meaningfully increase both the rent and the resale value without breaking your budget. And third, location fundamentals that support long-term appreciation. Look near expanding job markets, new transit infrastructure, and areas where supply is genuinely constrained. You're not gambling on a hot neighborhood tip. You're stacking probability in your favor. And when you find that property, you negotiate hard. The gap between overpaying by $20,000 and negotiating $20,000 off isn't just $40,000. Compounded over 20 years, it's a completely different financial outcome. Step 2 is optimizing what you own. Once you're in, you don't just sit back and wait. You treat the property like a business. Adjust rent to market rates annually. Make strategic improvements that justify higher rents. Keep vacancies short. Stay informed about what the neighborhood is doing. At the same time, and this is where most people zone out because it sounds slow, your wealth is building through 4 separate forces simultaneously. 1. Appreciation. The home value grows over time. Even at a modest 4% annually, a $400,000 property becomes a $600,000 property within a decade. 2. Mortgage paydown. Every payment chips away at your loan balance. While the house value climbs, the debt shrinks. The gap between those 2 numbers is your equity, and it widens every single month. 3. Rental income. If you're renting a room, a basement unit, or the whole property while living elsewhere, that income can offset a significant portion, sometimes all, of your housing costs. Your living expenses collapse. 4. Tax advantages. Depreciation deductions, mortgage interest write-offs, and the long-term capital gains treatment on real estate are genuinely favorable compared to other investment types. The government has structurally incentivized property ownership. Use it for engines, one asset, all running at the same time, without you doing much after the initial setup. Step 3 is where early retirement actually ignites. Let's use a real example. You're 30 years old. You buy a solid single-family home for $420,000. You put 20% down, $84,000, and carry a mortgage of $336,000. Fast forward 10 years. At a conservative 4% annual appreciation, that home is now worth roughly $620,000. Your mortgage balance, thanks to a decade of payments, has dropped to around $270,000. You now have approximately $350,000 in equity. Here's what most people do at this point. They keep paying down the mortgage, feel increasingly proud of themselves, and eventually celebrate the day it's paid off. And there's nothing wrong with that. It's responsible. It's sensible. But it's not the move that retires you early. Instead, you access $200,000 of that equity, carefully, deliberately, through a cash-out refinance or a home equity line of credit. You invested in income-producing assets, a diversified dividend portfolio, bonds, or a second property if you have the bandwidth for it. At a conservative 7% return, that $200,000 generates $14,000 a year in passive income from money that was previously doing nothing inside your walls. Repeat that process responsibly once or twice more over the following decade, and the compounding effect becomes genuinely staggering. The income streams multiply. Your expenses stay the same or grow modestly. And eventually, those streams catch up to your cost of living and pass it. That's the moment. That's when you realize work is now a choice, not a requirement. Now, let me address the elephant in the room. Yes, rates are higher than they were a few years ago. Yes, housing prices in many markets feel punishing. Entry is harder than it was in 2019. I'm not going to pretend otherwise. But here's the thing, the underlying math hasn't changed. Leverage plus appreciation plus time still works. A higher value asset in a constrained market can actually create more long-term equity than a cheaper property in a stagnant one. The conditions are different, not broken. And real estate has always had risks. Markets cool, neighborhoods shift, unexpected costs surface. But owning one well-chosen property gives you a level of flexibility that being overextended on 10 properties never could. You can adapt. You can adjust. You can make decisions from a position of control rather than desperation. There's also something almost primal about owning a tangible asset. Stocks are receipts for trust in a system. A house is a physical thing in the real world that people will always need. That's not nothing, especially in uncertain economic climates. Here's what the strategy is really about. Underneath all the numbers, it's a mindset shift. Wealthy people, genuinely, sustainably wealthy people, do not let assets sit idle. They understand that every dollar trapped inside a non-producing asset is a missed opportunity. They don't wait for permission. They don't wait for perfect conditions. They make deliberate moves early and then let time do the heavy lifting. This isn't about becoming obsessed with real estate. It's not about sacrificing your lifestyle today for some distant theoretical freedom. When you know your home is actively building wealth, your whole relationship with money changes. You negotiate harder at work because you have a cushion. You take smarter career risks because you're not desperate. You think in decades instead of months. One house won't make you a billionaire, but it might make you free. And free at 47 is worth infinitely more than wealthy at 70. Stop looking for the flashy strategy. Stop waiting for the perfect market. Find the right property. Treat it like the asset it is, and let compounding do what it's been doing reliably for generations. Financial freedom doesn't always start with a portfolio. Sometimes it starts with a front door,